Herzlich willkommen zu unserer heutigen Sendung aus dem Energiestudio in Berlin. Wir stellen Ihnen heute den neuen Gas Market Report der Internationalen Energieagentur vor, die Analyse zum zweiten Quartal 2025. Mein Name ist Charlie Grüneberg, ich leite die Kommunikation hier bei die Gas- und Wasserstoffwirtschaft und ich freue mich sehr, dass Sie dabei sind. Den Report werden uns die IEA-Experten Gergely Molnar und sein Kollege Frederik Ritter vorstellen. Und der Report wird wie gewohnt die aktuelle Lage auf dem internationalen Gasmarkt beleuchten und dabei einen besonderen Fokus legen auf die Versorgungssicherheit in Europa nach dem Ende der russischen Gastransite durch die Ukraine. Wir blicken aber auch auf das wachsende Gewicht der LNG-Importe und welche Rolle die USA und andere Länder hier heute spielen und künftig spielen werden. Die Veranstaltung wird aufgezeichnet, die Präsentation und der Link zur Aufzeichnung gehen Ihnen im Nachgang per Mail zu. Und wenn Sie Fragen haben, dann stellen Sie diese gerne über die Handhebefunktion oder im Chat. Und nun werde ich ins Englische wechseln und unsere Gäste aus Paris begrüßen. Welcome Gergely, welcome Frederick, thank you again for joining us. And a lot has changed since we last spoke. Europe's storage levels are lower, the competition for LNG cargoes has intensified, and US President Trump is now officially back, making headlines with his demand that Europe should import more gas from the United States. So we are very curious to hear how the IEA assesses these developments and what they mean for the gas industry in the months ahead. Gergely and Frederick, the floor is yours.
Many thanks for your kind words of introduction. Indeed, it is a great pleasure to be back at our traditional webinar. My name is Gergely Molnar. I'm a gas analyst at the International Energy Agency, and today I'm joined by my colleague Frederik Ritter for a presentation of our latest quarterly gas report, which indeed provides a look back to the previous heating season and also a short-term outlook for the year of 2025. The report is available free of charge on our website, iea.org. And today's presentation will, very much build on the structure of that report. First, we will have an overview of the global trends. Then we will have a focus on the European gas market developments. And then in the third part of the presentation, Frederik will bring us to the Asian markets. And then we will conclude with a summary of the LNG-related developments. So I think that the starting point is that natural gas markets are becoming increasingly complex. First of all, we have a rapidly changing geopolitical context with profound implications on natural gas markets and natural gas supply security. And this includes military attacks on natural gas infrastructure, commercial decisions being influenced by geopolitics, and an increasingly complex trade policy landscape. At the same time, we have a pattern of increasing weather sensitivity of natural gas demand. And this is partly because we have more frequently extreme weather events, but also we see that the rising share of variable renewables requires natural gas as a backup to ensure electricity supply security. And of course, we see that the regional interconnectivity is growing. Regional markets are becoming increasingly interlinked with flexible LNG, meaning that one region's supply-demand dynamics can transpire and influence the price dynamics of other more distant markets. So I think that this is just a broad analytical framework through which we are looking at natural gas markets. And of course, this growing complexity is also translating into a structurally higher price volatility. On this chart, we are showing the evolution of TTF and JKM prices since the start of 2024. The dark blue line marks TTF and the light blue line marks JKM. The key price in this for Northeast Asia. So, of course, after reaching their all-time highs in 2022, natural gas markets moderated down quite significantly in 2023, and this trend, in a way, continued until the first quarter of 24. But then we see that there have been a break in the trend, and basically both TTF and JKM prices doubled over 2024 and averaged roughly at $14 per MMBTU through the 2024-25 heating season, which is, of course, well above their historical price averages. And we believe that this strong increase in natural gas prices have been driven on one hand by tighter supply-demand fundamentals, but also geopolitical tensions fueled additional price volatility and provided additional upward pressure on natural gas prices. If you look at the very right end of the chart, we see that there have been a major sell-off since mid-February of this year, with prices declining by more than 40%. And this has been driven by a number of factors, partly by easing market fundamentals, but also certain expectations around the evolution of gas supplies might have influenced this major reduction in natural gas prices. I would like also to draw your attention on the gray area in the chart, which is the spread between JKM and TTF prices. We see that JKM traded well above TTF for most of 2024, which in a way attracted flexible LNG cargoes towards Asia. And we see that this changed over the 24-25 heating season, with Europe once again becoming the premium market, TTF trading above JKM and in a way attracting LNG cargoes towards the European shores. And we have seen quite a strong influx of LNG supplies into Europe since the start of this year, and we will discuss this a few minutes later. Now, when we are looking at the supply picture on this chart, we are presenting the key channels of global gas trade, which in our view includes European pipeline imports, China's pipeline imports, and global LNG supply. And I think that the bottom line here is that when we look back at the 24-25 heating season, we have seen quite limited increase in global LNG supply, which rose by just around 2%. And this has been partly because project delays, but also feed gas supply issues and unplanned maintenance. So there have been a limited increase in LNG supply, and some of that has been offset by lower Russian and Norwegian piped gas deliveries to Europe. So we are speaking about a fundamentally tight supply side. And when we are looking at the demand picture, I think that the most visible part of this slide is this very strong increase in natural gas consumption we experienced here in Europe, where natural gas consumption increased by almost 10% or 25 BCM. And that has been very much driven by a combination of somewhat colder winter temperatures, but also lower renewable output, which supported stronger gas-fired power generation. In the United States, we have seen also quite a strong increase in natural gas consumption. Actually, it rose to its highest level in our records for any heating season. And this has been mainly because of the colder weather conditions, especially in the first quarter of 2025. But I also would like to draw your attention on China, and Frederick will discuss this in greater detail. But here I just would like to note that in contrast with previous years, we have seen that Chinese natural gas consumption has been actually declining over the 24-25 winter. And this has been only partly because of milder weather conditions. There are other factors at play, including weaker macroeconomics and also some gas to coal switching happening in China, which is supported by the relatively high gas price environment. Now, I think that one important factor also to consider is what is happening with industrial gas use. And on this chart, we are presenting industrial gas consumption in China, Europe, India, and the United States. Now, these four markets account for roughly half of global industrial gas consumption. And we see that when we look back at 2024, the growth has been rather robust, especially in the first half of the year. In fact, we estimate that global industrial gas consumption increased by more than 3.5% in 2024. And it has been the single most important driver behind global gas demand growth in 2024. Now, we see that the trend has been towards a slowdown already in the second half of 2024. And our estimates shows that industrial gas consumption actually declined year on year in the first quarter of 2025 for the very first time since the 2022-23 crisis. And this has been driven partly by China, where we estimate that industrial consumption declined by around 3% in the first quarter. And again, this has been partly driven by slower economic growth, but also gas to coal switching dynamics in certain energy-intensive industries. But we also have seen quite a steep decline in industrial gas use among European users, which is a direct consequence of the relatively high price environment. And also we see a decline in India, especially in the fertilizer sector, where gas use declined by approximately 6%. Now, when we are looking at the short-term outlook, one important factor to consider is, of course, the evolution of the supply side. And our latest forecast indicate that global LNG supply would increase by around 5% or around 27 BCM, mainly supported by the ramp up of new major LNG liquefaction facilities in the United States, including Plaquemines in Louisiana, which is ramping up its deliveries at a very rapid pace, Corpus Christi Stage 3 expansion, LNG Canada, as well as Tortue FLNG in Africa, which shipped its first LNG cargo just a few days ago. In addition to that, we expect around 7 to 8 BCM more Russian pipe gas delivered to China via the Power of Siberia pipeline system. Now, all this growth is expected to be partly offset by the lower Russian pipe gas deliveries to the European Union after the halt of the Ukrainian transit in January of this year, which could reduce Russian pipe gas supplies by around 15 BCM. And in addition to that, we expect that EU storage injections could be significantly higher than they have been last year. And of course, the combination of all these factors paved the way for an outlook of tighter supply fundamentals in 2025 compared to last year. Now, this tighter outlook, together with the heightened macroeconomic uncertainties, means that we expect global gas demand growth to slow down from around 2.8% in 2024 to just around 1.5% in 2025. And as you can see on this chart, one of the key components behind this slowdown is actually the Asian market. Asia has been a very strong growth driver in the previous years. In 2024, we estimate that Asian natural gas consumption increased by 5.5%, mainly supported by China and India, which both displayed double-digit growth rates through the year. And now for 2025, we expect that Asian gas demand growth will slow down to around 2%. And actually, we see some downside risks to that. When we are looking at Europe, we expect natural gas consumption to increase by around 1.5% on the back of the strong growth we have seen in the first quarter of the year. In terms of sectors, we expect that the residential and the commercial sectors will be the most important driver behind stronger gas use and account for approximately 45% of incremental gas demand in 2025. In contrast, the high gas prices are expected to limit gas demand growth in industry and the energy sectors to below 1.5%, while gas to power demand is expected to increase only marginally in 2025 amid the continued expansion of renewables. Now, with that, let us move to the European market. So I think that the starting point is really this very robust gas demand growth we have seen over the 24-25 heating season, when natural gas consumption increased by almost 10% or 25 BCM. And this has been the strongest year-on-year increase for any heating season since the 2016-17 winter. And as we can see on this chart, this has been mainly driven by weather conditions. Colder weather supported higher gas use in the residential and the commercial sectors, where we estimate that natural gas consumption increased by roughly 6%. And then in the power sector, we had quite some lower hydro availability in the southern European markets, while in Northwest Europe, we had relatively slow wind speeds, which reduced quite significantly wind power generation and increased the call on flexible gas-fired power plants. We estimate that gas to power demand increased by more than 20% over the 24-25 heating season. And of course, this provided essential backup to the electricity system and ensured electricity supply security over the winter. When we look at natural gas consumption in industry, we have seen some increases still happening in the last quarter of the year, but the high gas price environment ultimately weighed on gas use in the industrial sectors, which declined across Europe in the first quarter of 25. So I think that obviously there have been this strong increase in natural gas demand in Europe, and It has been met through a number of mechanisms, but it also happened at a time when there have been stronger pipe gas exports from the European Union to Ukraine and the United Kingdom. At the same time, there have been lower pipe gas imports from Russia and Norway over the heating season, as well as the North Sea output continued to decline. So in this context, LNG and storage facilities played a key role in ensuring adequate gas supplies to the European market. Net storage draws increased by around 70% year on year. And we have seen that LNG imports surged quite significantly in the first quarter of the year by approximately 20%. Now, this steep storage draws have also naturally led to quite rapid depletion of European underground storage levels, which closed the heating season at just 34% fill levels, standing 11 BCM below their 5-year average and 25 BCM below their last year levels at the beginning of April. And this, of course, means that storage injections would need to be significantly higher than in 2024 if the EU wishes to reach its 90% fill target by the start of the 25-26 heating season. I would like to highlight the word if, as there is at the moment a lot of discussions both at the EU and national level, what is the right fill target for the upcoming heating season, with there being proposals made to include some flexibility around both intra-annual trajectories and the fill targets by the upcoming heating season. Now, what all this means for the European gas balance. So on one hand, we do expect that storage injections could be approximately 20 BCM higher than they have been in 2024. At the same time, we expect lower Russian pipe gas deliveries and a lower domestic output due to the aging North Sea fields. And there is also an outlook for stronger pipe gas deliveries to Ukraine. We expect them to be approximately 4 BCM higher than they have been in 2024, partly because Ukraine closed the heating season with historically low storage levels, and partly because some of the upstream facilities in Ukraine has been unfortunately damaged by Russian attacks, which means that Ukrainian domestic gas production is also at the moment lower than it has been in 2024. So when we combine all these factors together, we expect that European LNG imports would be more than 1/3 higher over the summer than they have been in 2024. This would translate in absolute terms to roughly 25 BCM more LNG imports compared to last year, in order to fill up the storages up to 90% fill levels, and also in order to ensure adequate supplies to Ukraine. And of course, this paint ahead of us a somewhat tight outlook, but I think that there are also very interesting dynamics in the Asian market, including this a slowdown in natural gas consumption. And with that, I would like to give the floor to my colleague, Frederick Ritter. Thank you.
Great. Thanks very much, Gerge, for handing over and for this first dive into global dynamics and, of course, the European picture, which I think is absolutely key to understand the global picture. As we'll see in the next couple of slides, particularly in the LNG section after Asia, what's happening in Europe is conditioning a lot of what's happening in the global market. So very, very important to keep everything that we've just heard in mind. So for now, I'm going to turn to Asia and the LNG market to give a little bit more detail on how we see the global balance shifting in 2025. And to highlight some of the key risk points that exist around our outlook. So Asia first, because this is the main global gas demand driver, as we've said time and again, and as Gerge has mentioned, accounting for about 1/3 of incremental demand in 2025. This is the single largest share, but it's also down compared to the 45% Asia accounted for last year in global demand growth. So what we see in 2025 is Asian demand growth slowing slightly more significantly than global gas demand growth overall. And this means that Asia will be a somewhat smaller driver of the global balance than before in terms of growth, but still remains the primary driver of global gas demand growth. Now, regarding the net slowdown in Asian gas demand growth in 25, China is the first factor to look at, of course, facing less favorable economic fundamentals this year. And mature Asian markets are also key here as well. After growth in 2024, they're back on a trajectory of decline in 2025. This is particularly tied to the progressive return of nuclear in markets such as Japan and Korea. Now, if we turn to the chart on the right, this gives us a bit of a more insight into this last point that I mentioned on the power sector. There are two sectors that are leading the downgrade in demand growth year on year in this region. The power sector is one of them. Renewables continue to grow across most Asian markets, and while power demand is generally strong across this region, renewables are eating into this residual load growth across a few markets. Hydro is also in better shape compared to a year or two ago. And as I mentioned, we see the return of nuclear plants in Japan as a key bearish factor in power sector gas burn for the region. Now, industry is the other sector leading the charge here on the demand side. It has been a key driver of demand globally and in Asia in recent years, but we see this role diminishing in 2025 as a result of unfavorable macroeconomic conditions and a bit of inertia effect from the relatively high global gas prices that were seen in the latter part of 2024 and that have somewhat come into 2025 as well. Although from Gerge's slides, we saw that there has been a clear easing in prices more recently. Now, many markets in the Pacific Basin are price elastic and have viable fuel switching options across a number of sectors, particularly in industry. So as soon as market tightness emerges, there is a risk to some of this demand growth. And this is a little bit what's behind this idea of both the power sector and industry being the key factors in the reduction in global gas demand growth, Asian gas demand growth. Now, I want to move on to China in the next slide because this is where much of our Asia story is unfolding. We're starting off here with historical demand by sector and at a quarterly granularity. After a period of strong growth and recovery in 2023 and through much of 2024, we see a clear shift in dynamics emerging starting in Q4 2024. So Chinese gas demand growth is facing a significant slowdown. In Q4 2024, we had relatively mild weather that helped ease growth. But this was also happening over a period over which Asian spot LNG prices gained ground over the latter part of 2024, and over which negative economic signals became increasingly evident in markets like China. So this continued into Q1 of this year with the industrial downturn deepening, and we expect this condition, to condition full year trends, even as demand growth is set to return later on in the year. Now, global gas prices have been easing recently, and if global gas dynamics continue to ease through this year, this would help soften the shift that has emerged in the first part of the year. We've flagged this downturn, however, in Chinese gas demand growth as a key risk in the past, but our successive outlooks have integrated an increasingly negative view of Chinese gas demand growth. So let's turn to the next slide to move into focus a little bit more on the outlook for China after having looked at this historical segment. So I want to remind people just how important China is in driving our forecasts. China accounts for about 25% of our expected global gas demand growth in 2025 and 75% of the upside in the Asia-Pacific region. So we expect Chinese demand growth to come in at just under 4%, which is down from close to 8% in 2024. This is a significant downward shift in our forecast, driven in great part, as mentioned before, by industry sector weakness. Now, to be clear, there is still underlying inertia, if you will, in the Chinese gas markets. We have growing residential and commercial connections to the gas grid, a wave of LNG-powered trucks that have come online in recent years, particularly last year, and a long-term trend toward increased gas use in industrial activities more broadly. But these drivers also remain vulnerable to overall economic headwinds and to fuel on fuel competition. So whether that be with diesel and road transport or other alternatives, potentially electrification and switching to cheaper fuels in industrial applications as well. Now, with this slowdown in demand growth, what can we expect on the supply side? This is what we see in the column, the right column in the chart on the left. So China continues to put emphasis on growing its domestic gas resources or the production of these resources. Growth has been strong in recent years, and we expect this to continue in 2025, although the incremental volumes from domestic production are likely to be slightly smaller than last year. Throughput on the Power of Siberia pipeline from Russia reached maximum capacity in late 2024, so we expect close to 8 BCM of incremental pipeline imports this year in 2025, as those flows stay at the 38 BCM per year nameplate capacity. Now, what we see is that this would essentially, taken together, these pipeline imports and domestic production would essentially be more than sufficient to cover incremental demand this year in China, which means that LNG imports are set to give way. And this is a monumental shift. China remains the world's largest LNG importer, but LNG plays somewhat of a balancing role in the Chinese gas market. So with weak demand fundamentals in recent months, high spot LNG prices as well, Chinese LNG imports from January to April were down by close to 25%, a huge decline. Now, we expect Chinese buying to recover throughout much of the rest of the year, but we currently forecast full year LNG imports to fall by around 4%. Now, this is quite significant, as I said. This is quite a change compared to the close to 10% growth that we've been seeing last year. Now, what about the rest of Asia? Let's look into this on the next slide. What we're focusing on here is other growth elements in Asia, and that's mainly India and the broad grouping of other emerging Asia. The big difference between India and other emerging Asia as a group is, of course, the consumption driver, whereas Indian demand growth is mostly driven by industrial and refining applications. Electricity generation, power generation is a larger driver in other emerging Asian markets, even though this is a relatively disparate group in terms of the precise role that gas plays in each of these economies. But what I want to focus on for a moment is the net slowdown in growth expectations for these markets. The white dot that we see in the chart on the left, so those two white dots, this is the incremental demand from 2024, and we see how that column for expected growth in 2025 is showing a significant slowdown this year. So again, macroeconomic uncertainty is at play, but there are also supply side factors that are essential here. Domestic production in some of these markets is facing impacts of aging resource basins and less dynamic activity than has been hoped for in recent years. The chart on the right gives us another level of understanding here. This is the share of LNG in total supply by markets. India is around 50%, and other emerging APAC markets have been increasingly reliant on LNG as well, though not quite at that same level. So in relatively tight market conditions, a high reliance on LNG can condition how accessible gas is to certain buyers. And we know that many Asian markets are rather price elastic, turning away from spot LNG purchases when prices are too high. And this is something that we have seen in the past months as spot LNG prices rose over the second half of 2024, while prices have eased since in early 2025. We know that a global LNG balance that is relatively on edge will continue to put pressure on some of these markets. So now that we've alluded to it, what exactly does our LNG outlook look like for 2025, and what will this mean for the global gas markets? Now, 2025 is set to be somewhat of a transitional year for LNG, with a clear acceleration in LNG supply growth, despite not yet being in the heart of the long-awaited wave of LNG coming online or coming to the market in the second half of this decade. After 2 years of relatively low liquefaction project additions, 2025 is set to bring about 27 BCM of incremental supply to the market. This is much needed relief in what is otherwise a tightening global balance, particularly linked to Europe, as Gergely has already covered in earlier slides. And North America is driving that extra supply with a number of new liquefaction projects ramping up this year. We've mentioned them already today. Plaquemines LNG and the Corpus Christi Stage 3 expansion projects in the US are increasing production this year. The former has had a very aggressive ramp-up schedule, coming online faster than previously expected and faster than usual for LNG supply projects. The Altamira LNG project in Mexico started exporting in August 2024, so full operations this year will contribute to this annual upside. And finally, we're expecting LNG Canada to start delivering cargoes around mid-year this year. Now, we expect that new projects will bring a total of about 27 BCM of incremental LNG to the market. This is taking into account, of course, downside in other markets. This is the net incremental volume. But this supply growth hinges on how successfully these projects will ramp up their operations. That means starting on time and keeping a steady growth in output in working toward that nameplate capacity. Now, our forecast supply growth also remains vulnerable to unexpected outages. Already in Q1, we have a couple examples here. There were unexpected outages in Norway in January. Pipeline sabotage reduced Nigeria LNG output in February as well. Now, while production at both of these plants has recovered since, it's a reminder that potential issues like these can easily tighten the LNG supply balance and reduce the net growth that we have forecasted. So to recap, we expect healthy LNG supply growth. That's important, but the market is not drowning in LNG. And when we look at it, any roadblocks in getting new projects online and getting them operational this year would have immediate effects on the markets. And the next slide on the LNG import picture will help us give us a little better sense, a little bit of a better sense on how the market remains on edge. Now, LNG supply growth is accelerating, as we've seen, but competition for this LNG is also intensifying in 2025. This is something that we've seen developing over some time, but we've also seen this this picture getting even more intense as in our successive outlooks. So here we're showing 2 years and two very different dynamics at play in terms of LNG imports. In 2024, Asian LNG imports grew by around 9% or 28 BCM, whereas global LNG supply grew by just 2% or just 8 BCM. However, the market balanced in those conditions because Europe significantly reduced its LNG take. European LNG imports fell by around 18% last year as Russian pipeline flows were relatively stable and European demand remained subdued. And finally, because storage injection requirements in Europe were relatively low. Now, dynamics in 2025 are quite the opposite. European fundamentals, the European fundamentals that Gergely detailed a bit earlier today, that's the fall in Russian pipeline flows, increased storage filling requirements, and overall more buoyant demand in Europe, mean that Europe will rely much more heavily on LNG to balance its market. So over the first 4 months of the year, European LNG imports were up by around 23% year on year, and we expect this trend to continue through the rest of 2025. Refilling storage this summer, as Gergely has mentioned, will require much more LNG than last year in 2024. So this means that Europe could take in over 30 BCM in extra LNG this year. We're forecasting actually around 33 BCM. So that's more than the net incremental supply coming to the market. And this increased competition for LNG will pull cargoes away from other markets, namely from Asia, where smaller, more price-sensitive markets are likely to hesitate to interact with the spot LNG market and to move away from buying, or to remain away from buying on the spot market. Now, China is of course a big factor here, as we've already mentioned, I've already alluded to. Remember from a few slides ago that we are forecasting a reduction in Chinese LNG imports. This is an exceptional change in terms of an outlook. Much of this downside is expected to have occurred in the first part of this year, as Chinese demand dynamics were weak. Spot LNG prices were relatively high as well. But overall, we forecast that Chinese LNG imports could shift from growth of around 10 BCM in 2024 to a fall of 4 BCM in 2025. Now, that's a relatively widespread year on year in terms of changing dynamics. So what we see is that Europe is not a balancing factor in the 2025 global LNG market. Europe is the main market driver on the demand side. It's pulling in much more LNG than last year. And this is essentially putting a strain on the markets that other more price-sensitive markets will respond to by relinquishing some of their LNG volumes, their LNG cargoes. So in short, yes, we have good LNG supply growth this year, but a tighter European balance means that the market needs this LNG. It's not just nice to have this extra volume that's coming to the markets. The global gas market remains on edge, and operational risks remain on the supply side. That means that prices will remain very responsive to any shifts in fundamentals. Now, this closes off the Asia and LNG sections, but I'll run through a few key takeaways just to recap some of the messages that we're trying to get across today. So natural gas markets are becoming increasingly complex and difficult to follow and to forecast. This is due to continued geopolitical tensions, rising weather sensitivity in gas demand, and growing regional interconnectivity. Natural gas prices remained relatively volatile over the 2024-2025 heating season, with tight supply fundamentals, stronger than expected demand in Europe, and of course that geopolitical uncertainty keeping markets on edge in terms of what to expect. Global gas demand expanded by an estimated 1.8% over the winter season, much of this growth driven by Europe and North America. In contrast, what we saw is that China's natural gas consumption declined, and this is a key factor in conditioning the rest of 2025 as well, when we're looking at Asian demand and Chinese demand more specifically. And despite stronger LNG supply, natural gas markets are set to remain relatively tight in 2025 amid lower Russian piped gas to Europe and higher storage injection requirements in Europe. Again, we're coming back to this idea that Europe is defining a lot, or a huge part of what will be happening in the global market today. Global gas demand growth is forecast to slow down to 1.5% in 2025. This is compared to around 2.8%, as we were saying, in 2024, due to a combination of initially tight market conditions and heightened macroeconomic uncertainties. And finally, Europe's LNG imports are expected to surge by about 25% in 2025 to their all-time highs, or close to their all-time highs, while LNG inflows to Asia are forecast to decline amid subdued demand. So a quite significant shift compared to the LNG market dynamics that we were seeing last year. So on that note, I think we'll hand it over back to you, Charlie.
Thank you very much, Frederick. Thank you, Gergely, for these insightful comments. I would like to pick up on a few questions that we have already received and invite you, dear viewers, to ask further questions in the chat or by raising your hand. You mentioned the role of Europe on the LNG market and how important Europe has become. Europe wants to increase LNG imports. Can the US keep up with the demand, or will there be new players who come up on this stage?
Yes, certainly. So I think that what we have seen since the 2022-23 gas supply crisis is how important have been US LNG in meeting European LNG import requirements, and this has been partly because US LNG supply is underpinned by destination flexible contracts. Now, when we are looking forward, we see a huge LNG wave unfolding over the medium term. Of course, there could be some delays on the road, but this is a massive addition of LNG liquefaction capacity, which is currently under construction. By 2030, approximately 270 billion cubic meters of LNG supply could come from these new projects, and more than approximately half of them are actually concentrated in North America, mainly in the United States. So I think that there is no question mark around that the United States can meet Europe's evolving LNG demand requirements. And I would like to highlight that we are talking about LNG demand requirements, which is also a factor of how quickly can Europe and the European Union phase out Russian pipe gas deliveries, for instance. So we are not talking only about the evolution of natural gas demand in Europe, but also about the evolving supply mix. And indeed, we foresee that the United States will play a very important role in meeting European LNG import requirements in the future, partly because of the geographical proximity, partly because of the cost competitiveness of US LNG supplies.
Mm-hmm. One important point when we talk about US is President Trump and his tariff politics. Could this lead to a new gas diplomacy between the US and Europe, or is it more of a domestic political signal to his voters? He's calling for more imports.
So certainly, as mentioned in the previous response, we see that US LNG can play a very important role and is playing a very important role in meeting Europe's evolving LNG demand requirements. And of course, this is very much underpinned by private contracts, by long-term contracts between market players. But there is, of course, an opportunity to strengthen the transatlantic LNG partnership further, which will be a win-win solution for both sides of the Atlantic.
Mm-hmm. Then you also, of course, mentioned China and its weaker demands. There are also some threats of China to pose tariffs on US gas. What market distortions are possible here? And could Europe benefit indirectly from US LNG increasingly serving the Atlantic region, or will there be other Asian countries who will take a benefit from this development?
Yeah, I can jump in here. It's a good question. So broadly, we don't think that the current Chinese tariffs on US products, which would include LNG, or which does include US LNG, we don't think that this is going to be a huge market distorting factor. We don't think essentially this is putting an extra strain on the supply side. What it does is that it means that requirements for Chinese LNG buyers are now increased. Maybe their workload is increased in redispatching these volumes to other markets so as not to bring them into China and to have to pay tariffs on them. But we don't see this having a very big effect on global supply pressure, and we already see Europe having taken advantage in the sense of the availability of US gas remaining in the Atlantic basin. So no huge effects here.
Mm-hmm. Let's take a look on the Germany's LNG terminal situation. Germany recorded the lowest utilization rate of LNG terminals in Europe during Q1. How should we interpret this development in terms of Germany's role in the European gas market, and what implications might this have for future infrastructure investment decisions?
So this is once again an excellent question. I think that first of all, to commend Germany for very rapidly deploying all the LNG regasification infrastructure, which was indeed very much needed to tackle the 22-23 gas supply shock. I think that we need to consider that first of all, there might be some technical limitations due to interconnector capacity, which might limit the utilization rates of certain LNG import terminals in Germany. And second, I think it is important to recognize that the regasification facilities act also by providing a certain security buffer to the market. So it is, of course, in a way natural that there are periods of the year when their utilization rates are lower than average. But this can quite significantly change if, for instance, there is a strong increase in natural gas demand, or if there is a reconfiguration of continental trade flows in Europe, or if there is, for instance, an unexpected outage, which impacts, for instance, the pipe gas deliveries to Germany. So I think that it is important also to consider that regasification facilities also provide a security buffer to the market, and this value should not be overlooked.
Let's take a view on Russia. Russia remains present through the back door. Despite sanctions, import of Russian LNG and also pipeline gas to Europe are growing. How do you assess this development, and can new political reactions be expected here?
Do you know if the question refers to the current imports of Russian gas, or for the future?
Current.
Okay, well, so I think that there is obviously an uncertainty around the evolution of Russian gas deliveries to Europe. What we have seen in 2024 is actually an increase in both Russian pipe gas and Russian LNG deliveries to Europe. Now I think that there is a plan to phase out Russian energy by the end of 2027. This remains, I think, the strategic direction the European Union is undertaking. Now, obviously, there will be internal debates around that, and it is, I think, too early to comment on that. But I think that what is important to note, strictly from a market perspective, is that by 2027, we will be in a very different global LNG market environment, mainly because of this strong increase in LNG supply, mainly coming from the United States and also from Qatar. So, this creates, of course, additional flexibility options, and I think that's probably something to take into consideration.
Mm-hmm. Then let's also have a look on the storage levels. You mentioned the strong decline in the previous heating period. How serious would you say the situation? How is the market reacting? And what do we have to do to get a good storage level for the next heating period?
When we look at the storage injections, since the start of April, I think they have been up by about 70% compared to last year of the same period. So I think that looking at these recent trends, they are quite encouraging that the European Union would be able to fill up its storage sites to adequate levels. But at the same time, there is no reason for complacency. You know, we started this webinar by saying that gas markets are becoming increasingly complex and difficult to predict. There could be, you know, unexpected increase, for instance, in natural gas demand. If we have a dry and hot summer, there is, you know, a lot of uncertainty around the developments in China, whether the appetite of China could come back, and this, of course, could potentially also reduce the LNG availability to the European market. So I think that there are some uncertainties, but the most recent trends are quite encouraging. And maybe to say that we have also seen that the seasonal spread on TTF has became positive after spending most of the time in negative territory over the heating season. So, you know, this also helps. This provides also some incentive to fill up storage levels. Now, maybe just to note that there is a renewed concern maybe around the financial viability of certain storage sites, and we hear that for instance in southern Germany there is one storage site which faces the risk of being closed by 2027. So I think that that's an important topic for policy considerations on how to ensure the economic viability of storage sites in Europe, because they are an essential and strategic facilities to ensure natural gas supply security in Europe for a long time ahead of us.
Thank you very much. And the last question for today for Frederick. Frederick, you mentioned 2022 as a transitional year for LNG. Also, we see LNG liquefaction capacity is growing. So when we look onward to 2026, what do you expect the situation will be also regarding the prices?
So in our latest report, we don't push our forecast beyond 2025, but I think this is of course something that'll be coming up in our next reports, our medium-term outlook. Nevertheless, what has been on the horizon for quite a while now is the next wave of LNG liquefaction capacity coming online over the second half of this decade. 2025, as mentioned, it's a transitional year. We do see some of that capacity coming online, some of that supply coming to markets. But the peak of that next wave is not expected this year. It's expected more in the 2026-2027 time range. Of course, this will be conditional on exactly when projects starts. We have seen a lot of projects in the past starting a little bit later than expected, others starting on time, ramping up faster than expected. But it's always a little bit of a game of, what our expectations are in terms of when projects start. Nevertheless, we do expect 2026 and 2027 to bring more supply to the market, and this is expected, ceteris paribus, we'll say, to ease global LNG and global gas market dynamics.
Okay, thank you very much, Frederick. Thank you very much, Gergely, for these fruitful insights in the international gas market. It was again very interesting, and we are looking forward to the next report in 3 months. Die Märkte, meine lieben Zuschauerinnen und Zuschauer, bleiben also unter Druck. Wir haben gelernt, der internationale Gasmarkt wird immer komplexer und die globale Energiesicherheit steht weiterhin vor großen Herausforderungen. Wir werden für Sie die Analysen im Blick behalten. Ich danke Ihnen für Ihr Interesse, für Ihre Fragen. Wir werden Ihnen die Präsentation und den Report im Nachgang zu dieser Veranstaltung zusenden und die Aufzeichnung finden Sie zeitnah auf unserem YouTube-Kanal. Ich wünsche Ihnen noch einen erfolgreichen Tag, eine erfolgreiche Woche und bleiben Sie gesund.